So what this interest table does for you is that instead of you using those formulas we use in school, you simply know the interest rates, then know the number of years or number of payment terms. Then you can easily go and deduct the factor to use. So once you get that factor, you can now multiply with the principal or the future to get the corresponding value. So this is what the interest table is. Here you will see that this is the first page is for 0.25%. The next one is for 0.5%. The next one is for 0.75%, and so on and so forth. And this interest table is an open source. You just go to Google, type interest table. You can try it out. You will see millions and thousands of it. So this is just the one I felt we can use. But you can still go to your online and you can download any of them. So that is that. So let us open our material for today, which is webinar 4. Webinar 4, Cost and Economic Analysis. My laptop is pretty low this morning. I don't know why. So what you need to do in this interest table is, when we start, you don't need to use the formulas. You simply know what interest is the amount compounding at, and then what is the number of payment periods. So what you have, this N is the number of payment periods: 1 year, 2 years, 3 years, or if it is monthly, it will be first month, second month, third month. Then you now know what are you looking for. This is compound amount factor. It means I'm looking for, it says find F given P. So in other words, this is when I want to find the future amount of a given present value. Okay, if I invest 100,000, for instance, at a particular interest rate, at a particular number of years, what will I get? So if you look at this first one, if I give you 100,000 naira at interest rate of 10%, so here you multiply this factor by 100,000. If you'll agree with me, if you multiply this by 100, you're going to get 110,000. So that is what this interest rate does for you. Then if I'm looking for the reverse of this, in other words, I have the present factor, the present value, and I'm looking for the future. Then it means I will use the table under this one. Then these ones are for single payments. When we mean single payment, it's like you're loaning somebody money or you're investing money and you're expecting such amount of money in the future. So it's a one-off thing. But in this case, in this 4 you have here, it means it's a uniform payment series. When we say uniform payment series, it means we are looking at compounding. It means the interest is compounding. And there are 4 parameters you can get using that interest table. You can get a sinking fund. And what is sinking fund? Sinking fund is when you are looking for the annual worth of a future investment. I want to buy a car worth 2.5 million. How much will I be paying every month, every week, or every year, depending on the payment arrangement, for me to be able to generate 2.5 million in such a number of years? The other one is what we call capital recovery factor. The capital recovery factor is I have a particular amount of money and I want to recover the money within a certain number of years. So that is capital recovery. Then we also have the compound amount. So the compound amount is if I'm investing an annual amount of money every year, every month, in such a number of years, what will I be able to generate? So I'm just trying to do an introduction to all these parameters, but we're going to go into them in details with a lot of examples, with exercises. We're going to solve exercises. That's why I said, have your pen and paper close by, because we're going to go into some mathematical calculation for today. Okay, I think I'm still trying to open my Okay, I think I have the opportunity of opening it now. Okay, people are still joining in. We have 48 people now. So that is the interest table for you. Then the last one, but not the least, is the present worth. Present worth. When do you need a present worth? Okay. Present worth means I'm looking for the present worth given the annuity, annual amount. Let's say somebody wants to be giving me 10,000 naira every month for the next 1 year. If you ask a layman, he will tell you, well, at the end of 1 year, you're going to get 120,000. But in economic terms, that's not real. If you consider the time value of money, okay, if somebody's giving you 100,000 every year for 5 years, don't ever imagine that after 5 years, you are richer by 500,000. No, money lose value. So by what amount will the money have a compounded or depreciated? So that is what you use this to get. Okay, so you just come here, you now know how many number of years, okay, and what's the interest. So the top here is where you look out for the interest rate. Then down here, you look for the number of payment terms, which could also be number of years, if it's a yearly payment. Some payments are made monthly, some payments are made weekly, some payments are made bi-weekly, some payments are made in decades. So it depends. So all we know is how many times are you, how frequent, what is the interval of repayment? That is the most important question. Okay. Now I think my slide is on. Okay, thank you. So today we're going to be discussing economic and life cycle costing. I love this concept of life cycle costing because that is the most modern way of analyzing projects. When we talk about life cycle costing, it means we are not just talking about the initial investment to a project, to an energy project. You are looking at the whole life cycle of that project. And when we talk about whole life cycle of the project, we are referring to the maintenance costs, the licensing costs, the renewal costs, as well as the initial investments. One of the examples I always give people is when you go to the shop, when you go to buy a laptop, and the cost of the laptop is 250,000, and they ask you how much did you buy the laptop, you say 250,000. But you will forget that you took a transport to go to that place. And after buying the laptop, the guy in the shop also asked you to buy an antivirus, 20,000. The guy selling charger say you must buy charger, 5,000. The guy selling Microsoft say you should buy Microsoft, 2,000. And there's a fixed annual maintenance cost for the laptop of another 20,000. So by the time you put all these things together, that's what we call life cycle costing. So you are looking at the whole life of a project. That is why is it important in energy projects? For instance, in the renewable energy project, when you invest when you store your first let's say a mini grid system, after 6 months, believe me, you need to change the batteries, or after 1 year, depending on the kind of whether it's a lithium battery or a lead acid battery. So in you doing your cost analysis, you must consider the fact that battery constitute almost 50 to 60% of the cost of my investment. It means within 2 years, I'm going to change the battery once. So in your building your costs, you must factor in that the cost of the battery, and that's why most of these projects fail. Because after a while, the battery fails and there's no more, because the cost of replacement is not factored in. There was no adequate life cycle costing that was done. The project becomes moribund. Now, the concept of life cycle costing is built on what we call the time value of money. So this is what economic analysis means. You do economic analysis when you have options, when there are alternatives. When you say I want to do an economic analysis, what you are trying to say is that there are alternatives. And in energy auditing, there's always alternative. There's a machine coming from ABB. There's another one coming from Siemens. And there's another one coming from whoever. Okay. There is a proposal coming from Julius Berger, and there's a proposal coming from whoever. So you as the engineer, you as the energy auditor, you must have that capacity to be able to do the economic analysis. Also, you do this economic analysis to convince your clients that if you didn't do this, carry out these energy efficiency measures, you will continue to pay a huge energy bill. But if you do this economic analysis, if you apply this low cost measure, this is what you get. If you apply this medium cost measure, this is what you get. If you apply this high cost measure, this is what you get. You must give people option as an any auditor. You must present your auditing in such a way that your client will have the freedom of choice. You can also present it by bringing in the different interest rates and comparing it with the, what do you call it again? The inflation rates. That also goes to help. So, talking about economic analysis. Okay, can read all of this. So the time value of money. You see, $1 today is worth more than $1 in the future because money has earning power. In other words, if today you put $1 in a bank where it earns interest, it is worth more than $1 tomorrow. This change in value over time is called time value of money. Some have called this the most important concept in economic analysis. As an example, think of the price of a car in 1980. A car would have cost about $20,000. Today, a car is about $30,000. So in about 30 years, your initial $20K will only pay 2/3 of the current cost of a car. Okay, so having said that, let us explain some of the economic terms you'll be encountering. My colleague will come on board. When he comes on board, he'll go through this again. Okay, that's the arrangement, so that the thing will it will sink in. The first economic analysis terms is what we call annual value. For the annual value, he said the annual value is a series of equal cash flow. Series, it must be series. It must be equal. Okay? Most often, savings, it could be savings. Most often is a savings that occur evenly spaced over time. In this course, we use end of year accounting, meaning that cash flow occur only at the end of the year. A, which is the annual value, is also known as the annuity amount, also called annual worth method. So whether you call it as annual value, you call it savings, you call it annuity, or you call it annual worth, they mean the same thing. And what are we talking about? We're talking about those terms that you are going to receive. For instance, if you implement an energy efficiency measure, there's a particular amount of money that comes to you every year or every term. So that a particular amount of money that comes to you every term or every year is what we call, becomes the annual value. Let's say you invest 200,000 in building your renewable energy system, and every year, instead of paying 20,000 every month, instead of paying 20,000, you are paying 10,000. It means your savings is now 10,000. So it means your annual, or in this case, monthly worth or monthly savings is now 10,000. So that is what we call by annual value, or A. The second one is the present value. Okay, is the present value, or we call it the PV. And we say this is the value of the future amount in today's dollar. For cost, this is the cost now in most cases, also called the present. So what I call it the present worth, call it the present value, or call it the initial cost or the initial investment. They mean the same thing. And they can be represented as either a P or PV. In using Excel to do it, using computer to do it, Excel sees it as PV. So Excel will say PV, present value, while the first principle method just call it P. The next economic terms is the future value. Engineer Shi, are you around?
Yes, good morning, sir. Yes,
yeah,
I'm
good
around.
Morning. I've just started before you came in. I don't know what I should.
No problem. Go on.
Okay,
What do you want?
Maybe next week.
Okay.
No next week. Let's see how it goes.
Okay, no problem. Go ahead.
Okay, sir. Okay. So then the next one is the future value. The future value is the value of a single deposit amount or a series of payments at some future point in the future, also called the future value. So the future value, it simply means if I invest 100,000 in the bank today, in 5 years' time, how much would that 100,000 be? Of course, the 100,000 will not be the same because I'm investing. So if it's at 10%, it means every year they'll give me 10,000. So in 5 years, I'm getting around 150%, even though that will be slow, that will be lower. When you do the mathematics, you find out that it's not going to be 10,000 every year, because at the end of the 5 years, that money have lost value based on the prevailing inflation rates. Okay. So life cycle costing, I've talked about it, is simply the sum of all present value of the cost of a system over its lifetime. Sorry. Good. So if I'm talking about life cycle costing, it means what is the maintenance cost, what is licensing cost, what is the renewal cost, what is this cost, all the costs, aggregate them. And that is the best economic way to analyze a project. Don't just, they give you a contract, for instance, and the contract is 100 million, and you check the cost of executing it is 80 million. You say, oh, I'm going to make 20 million. No, you are wrong. By the time you do the life cycle costing, you find out that ordinarily cost of borrowing will take another 10%. So you are down with 10% only. Then overhead, staff payments, delay, and what have you. At the end of the day, it's an abandoned project. Okay. Then the next one is the net present value. Now, whenever you hear the word net, is talking about the difference between these two things. So the net present value is the difference between the present value of an investment and the initial investment, the present value of an investment feature, net cash flow, and initial investments. Okay, so simply put, if I buy a laptop for 200,000 and I use it to work, and I make 300,000, and the laptop died, let's say, or the laptop the salvage value is zero, it became zero. It means my net present value is 300 minus 200, because the inflow is 300 and the outflow is 200. So the net is 100. But the net present value have some implication. For instance, if the net present value is zero, it means outflow and inflow are equal. It means I'm not making profit, I'm not making loss. Okay. And the interest rates at that point where the next NPV is zero is what we call internal rate of return. So number 5 and number 6, they have a kind of they have something in common. Whenever at that point where your net present value is zero, your internal rate of return, your is zero. That point, the interest rate at that point is called IRR, which is internal rate of return. So why is it important? At every point of a project, you must know when the NPV is zero. When you establish that the NPV is zero at 5%, it means if I take loan above 5%, I'm going to lose. But if I take loan lower than 5%, I'll make profits. So this is very, very important, because sometimes you go to bank to take loan and they'll tell you they're giving you loan at 18%. So you need to do your own calculation and find out if at what interest rate is your NPV zero. So if you do your interest calculation and your NPV is zero at 10% and they're giving you loan at 18%, then you're going to make a huge loss. But if your NPV is 30% and they're giving you at 18%, it means you are getting 12% interest. It means that business is going to give you a lot of money. So NPV is a point where banks use to establish a baseline for borrowing. CBN gives them at 11%, for instance. When they add allowances of the bosses, overhead, what risk and everything, they'll be coming at around 18%. And when you approach them, they'll be giving you at 22%, because they want to give out that room, that 4% room for extra profit or for based on your risks, the risk of the project you're coming. Okay, I'm trying to lay a foundation before we go into the mathematical calculation. Now, interest rates. Interest rate is simply interest rate. Let me say this. Sometimes it doesn't come as interest rate. It comes at finance rates. It comes at hurdle rates. It comes at discount rates. It comes at minimum attractive rate of return. So whichever way it comes at, or you see it, whether in exam or in real life or in your normal day-to-day practice, just know that the interest rate is flexible. If you are borrowing money, you call it the finance rate. And that is the rate that you are charging. So it means you are at the receiving end. Conversely, if you're investing money in an account, the interest rate indicates how fast the money will grow over time. Okay, but if you are borrowing money or you are moving money backward through time, you now use the discount rates. So that's why you always have to know what is the future value and what is the discounted value. Always remember that word. What is discounted value? For instance, now those of us who do a lot of contracts, if you collect a contract from government, 12.5% or 13.5% of that money is not yours. So most times when you tell somebody, oh, I have this job, it's 10 million naira, you can't get paid more than 9 million because it has been discounted. You have to pay VAT, you have to pay tax. And if you also borrowed money to do that work, it means around 20 something percent is off. So if you're not talking about the contract or a job of 10 million, just have at the back of your mind that the discounted worth of that contract is at 8 million. Yes, because 2 million will go into servicing loan, servicing government, servicing stamp duty, servicing withholding tax. So knowledge of this economic interest is so important in renewable energy project because why is it important? Most energy projects have a lifespan. They don't last forever. So it means you need to recoup your money within an established timeline. 2 years, 3 years, 4 years, 5 years, you move out. If you go beyond those periods, most likely your costs will shoot up, just like what we're having today in most of our poor projects in Nigeria. Once they've reached a certain lifespan, we don't discard them, we don't do another investment in them, and they now, just like the refinery, let me not go into that. The cost of maintaining a Nigerian refinery is as good as building a new one because the project has outlived its usefulness. After 30 years, you need to scrap some things and move on. Okay. Then minimum acceptable rate of return, we've discussed it. Okay. He says the rate determined by a company organization to be the minimum allowable required for investments. Meaning every company, even individuals, should have MARR. It is that point which I said where your MPV is 0, which is your IRR plus your markup. So I see the minimum acceptable rate of return. It is that rate where you as a person says, anything below this, I'm not doing. As I said, as I gave reference with the banks, when CBN gives them money at 11%, they can't give you money below 11%. They can give you at 14%, they can give you at 15%. Well, depending on who you know, by the way. But in that extra thing they've added, they have captured in their overhead. I told somebody that Julius Berger cannot do a project that does not have a clear interest or payback margin, a kind of a markup of 50%. They cannot do it. Some people say, if you give me a work and I don't see 20%, I'm not doing. Some people say 10%. So it depends on your individual. It depends on your interest in the job. It depends on your overhead, and depends on who is sponsoring you anyway. And that is how you now establish your own MARR. Depreciation, amount of economic value that is used up during the economic period. Depreciation is not a cash flow. It is for accounting purposes only. Payback period is simply the amount of years needed to recover an initial investment. So when you hear payback period, it simply means if I invest 100,000 for 5 years and they are paying me back, if I invest 100,000 and they want to pay me back 20,000 every year, it means my payback period will be 100 over 5, and that is 100 over 20, which is 5. So my payback period will be 5 years. So if you know the total amount of the investment, you divide it by the annuity or the savings. Remember, I said A means savings, it means annuity, it means annual worth. So if I divide the present value or the initial investment by the savings it will give me, then I'll be able to know the payback period. So we have the simple payback period and we have the discounted payback period. Okay, so the discounted payback period simply means you would have discounted the initial investment using the minimum attractive rate of return. So the discounted payback period is more accurate because it takes into account the Yeah, thank you, Daniel. So, but yeah, 13.5% is off. Thank you for government contracts in Nigeria. Okay, the employee didn't add your cost of borrowing unless you're using your personal money. So cost of borrowing, add another 10,000, 10%. So that makes it 23.5%. So if you are doing contract in Nigeria, just know that 23.5% is off. Assuming you are borrowing money anyway from microfinance bank. Okay, that's a good one. So if you have anything to contribute and you don't want to stop the flow, just go to the chat box and you make your point known. Okay, we have what we call the salvage value. Okay, it's the value of the equipment at the end of the project life. Sometimes salvage value is positive if you're going to sell it at the end. Sometimes it's negative if you're going to pay to remove it or dispose it. Okay, but we say that salvage value is usually ignored in this section. But if it does not occur in a problem, treat it as a future value. As I said, solar panels last for 25 years. So after 25 years, forget about it. Most batteries, I don't see any battery lasting more than 2 years, even if they are lithium batteries. Lead acid batteries is 6 months to 1 year. I stand to be corrected. So you need to factor in those things. And most times, salvage values are difficult to get. Simply dispose them after their lifespan. Dispose them. Don't expect to get anything from them. But if peradventure you get something, okay, that's good for you, but it's going to be very minimal and very negligible. So if you want to be very smart, just consider that salvage value is 0. That after 5 years, the thing packs up, the battery packs up, there's no salvage value. After 10 years, this car is as good as gone. Then the probably the last one is the lifespan. When we say project, what is life project? If you ask to define project in a nutshell, a project is anything that has a beginning and end. As a layman, that's a simple way. Once something has a beginning, it has an end, it becomes a project. So meaning that there must be timeline. You must factor in the place of time. You must factor in the place of time. Okay. Now, we're moving close. Engineer Ishi. Hello?
Yes, sir, I'm with you, sir.
Okay, I think I should continue.
Yes, go ahead. If you want to do some introductions after this, before your calculations, I can come in.
Okay, good.
Thank you, sir.
Yeah. Okay, now, before Engineer Ishi comes in, let me just give my perspective to what you'll be encountering and the smartest way to get them. For every economic analysis you want to do. Now, what we're doing today, by the way, is not just limited to power projects. This is engineering financial analysis, which we also offer in another course we do. But we feel that as to you to be a all-round energy auditor, you must know how to use interest table, you must know how to use Excel, you must be good in Excel, and you must be able to understand economic and financial terms. This is good. It's something worth knowing, not just because of this class, but for our future engagements. Whether you want to write PMP, you want to write CCP, you want to write ICANN, you're going to meet these things. You want to write whatever beyond engineering. These are things that they offer in MBA classes. Okay, now, in the mathematical expression, you'll be seeing things like present words represented as P. You'll be seeing things like future words, F, okay? Amount of money at the future time. Then you'll be seeing a series of consecutive equal end of year period amount of money. So there's A, there's F, there's P. Then you'll be seeing N. N can mean the number of interest period. It can also mean the number of years of the project. The interest period and number of years, in other words, the project has a beginning as an end. So if you're taking a loan for 5 years, it means the lifespan of that project is 5 years. You expect the project to end or the contract to terminate at the end of 5 years. Then you have the interest rates. There always be interest rates. In moving money, there's always interest. Okay, because money loses value with time. So it's only interest that can be the balancing factor. Now, in these 5 terminologies, 2 are constants, 2 are ever present, 2 are almost untouchable, and that is the interest rate and the number of interest period. These two parameters are always there. They're always present. So you now have to deal with the three. And those three is, am I looking for the future what? Am I looking for the present what? Or am I looking for the annual what? Now, let me tell you this. If I give you 120,000 and ask you to pay me back 10,000 every month, it means the present what is 120. The annual or monthly the monthly what is 10,000. Though that might not be correct. At the end of 12 months, it might be more than 120, I know, but let's assume that we're not considering time value of money. So I want you to understand that relationship between P and A. A simply means, break it down. What are the savings? I use ₦1 million to invest on solar and battery in my house. And instead of paying 20,000 naira as energy bill, I am now paying 10,000. It means my savings every month is 10,000. So at the end of the year, the annual worth of my 1 million naira investment is 120,000. So it means every year I'm saving 120,000. So in me presenting it to my clients, I'm going to tell my clients, if you invest 1 million naira, changing these lights, ACs, refrigerator, and then I do the costing, the economic costing, and I got 10,000 and in a month, then I will not tell my client that the annual worth of this investment is 120,000. So with 120,000, I will now do 1 million over 120. It will give me the payback period. Okay, and that will be in the range of 8 years or 5 years. But let me say this: in energy and basically in energy, in the renewable energy sector, don't go for projects that have payback period of more than 3 to 5 years. It's an advice. Within 2, 3, 4 years, get your money and leave. So even if I'm building a mini grid or a solar farm or a distributed energy system, you must have in mind that, look, okay, after 3 years, the deal is no deal. After 3 years, you either change the whole battery or you do a fresh round of investment. Okay, let's move forward. I think we have a lot to do. We're already almost 1 hour gone. Now, a little bit of cash flow diagram. Every project has cash receipts, income. So whatever that comes to you is known as income. It's a receipt. And then cash disbursement, costs. So there's something that comes in, there's something that goes out. So that is inflow and outflow. Then, so the net cash flow, this is very important. Your net cash flow becomes the difference between your receipts and your disbursement. That's the net cash flow. And this net cash flow, this is what you now assume to be your A. This is now what you assume to be your annual worth. Okay. All right. Yeah. So somebody asked a question. Say, what about IPP using gas engines? Will you give the same advice for 3 years? That's why I say renewable energy. Renewable energy, sir. I didn't say, I was careful not to use the word power project. I almost did, but I remember that it doesn't apply. Renewable energy projects, sir, because of cost of battery, inverter, or some of these things don't last beyond 5 years. Gas turbines can last for, God knows, 15, 20, 25 years. Okay, some pumps in Germany now, the one they are using coating, a special coating, they say it will last for 100 years because those abrasions have been eliminated. Okay, but I said renewable energy projects. All right. So the next thing I want to explain to us is cash flow diagram. Just have it in mind that once cash is coming, if it's something that's coming in, it goes up. If it's something that's leaving the system, it comes down. You can read and understand this. Okay, a typical example of a present value. He said, what is the present value of 10,000 to be received 5 years in the future? Okay. So if this is year 0 and we have 10,000 naira in the future, the present worth, if we are discounting, at 10%, it means today that money is worth 6,209 naira. So it also means, conversely, if you put 6,200 naira in the bank at 10% interest, in 5 years, you should be getting 10,000 naira. That's what it means. So it can be vice versa. You can move this way, you can move that way. But just for you to see, if you are moving money over time, the money based on the prevailing interest rates, which also has a correlation with the inflation rate. That's what let's tell people. If you want to know, have an example of interest rates in a country, look at inflation rates. It is difficult for interest rates to be below inflation rate. That is why Nigerian banks will give you money at 25%. By the way, most microfinance banks in Nigeria are giving interest at 5% per month. So in a year, 12 times 5 is 60. Yes, 60%. And that is huge, by the way. But that is to tell you how inflation in a country influences the interest rate. Because no bank can give you interest money below the prevailing inflation rate. It means that the money will lose value. It means if I give you money, 10,000, even if I'm giving you 10%, which will give you 11,000 at the end of the year, and the inflation rate is 20%, it means you are back to what by minus 10, that kind of thing. Okay. At this point, let me just give us, take us back a little bit during our school days. When you go to your school, during our school days, we were introduced to formulas that if you want to find the future value of an amount, you multiply it by the 1 plus interest rate raised to per number of years. That's what we are taught. Okay. But today, we have moved beyond that. What we are doing now is what we call using the interest table. So the interest table simply means everything inside this bracket, you can get it from the table. You can get the interest rate at a particular number of years at a particular interest. So once you get this value, if you're not asked to find the F, instead of putting this and doing the mathematics, you simply substitute everything inside this parenthesis by the factor from the interest table, then multiply by the present value. The future value will pop up. We're going to solve examples. So this looks simple because this is what we call single payment. It is a one-off thing. Then the opposite of it is if I'm looking for the present value of a future amount, I'll simply multiply the interest table. Okay, here, sorry. I'll go to the table and pick up this and multiply it by the future amount. I will get the present value. Okay, so this one looks easy because they are all single payments. It becomes more complicated when we now go into uniform series, or the one we call compound factor, compounding. It means that as the money you borrowed is being reinvested or being re-owed, your interest is moving on marginally. So if I borrow 10,000, after 1 year, the new capital becomes, at 10%, sorry, the new capital becomes 110,000. The second year, the new capital becomes 120,000. The third year, the new capital becomes, so the interest I'm supposed to pay, because it's compounding every year. So if you look at this mathematical formula, nobody uses this again. This is what we introduced in school, and it makes it difficult for us to cram. But today, you just go to the interest table and say, what is the interest rate? What is the payment period? And what am I looking for? So when you see P over A, it simply means what I'm looking for over what I'm giving. I will explain that. Let's go to the next one. So there are about 6 of them that I described at the beginning. This is how it is. So in this case, this is capital recovery factor. So capital recovery factor means I am looking for A, I am giving P. So my tip is this. when you see this formula like this in the interest table, what this thing means is that everything that is under is what I'm looking for, what I'm giving. So everything under is the values you are giving. So in this case, you'll be given the P, you'll be given the I, you'll be given the N. You will now be asked to find the A. So that's why the formula is this. So if you look at this, you see the formula is this. So everything inside this bracket, you read it off as a single value from the interest table. You read it off as a single value from the interest table. Everything inside this bracket. You will now multiply by the P. And then you find your A. So this is why you see this formula. So this formula means I'm looking for A and I'm giving P. Of course, I will give I and N. I say that I and N are always present because every project have an N. Or every money borrowed has an N. It has an N. It has when you are expected to pay back or when you are expected to finish the project. And then the interest rate means there is interest. If there's no interest in the project, use inflation value. And that is an advice for engineers. If they give you any project, please factor in if the project will last beyond 1 year. Just know that the value of the project would have increased by the prevailing inflation rates. But of course, there's always interest because we expect to borrow money to calculate. You want to ask something? No. Somebody said, how do you calculate inflation? I think it's economics and CBN that does that. But what they do is that there's what they call inflation basket. Inflation basket is that you bring in a basket and you put in about 1,000 products, about 1,000 products, then you find the average increase in prices. There's how they do it, but it's beyond the scope of this class. Okay. Now, but if you want to know the inflation rate, just go online. I think the inflation rate in Nigeria last year was 16%. CBN.gov, you see the inflation rate. Or any country, for instance, the inflation rate is there. US is about US is 0.6% or thereabouts. But Nigeria is hitting God knows what. Okay. Please let us meet ourselves, please. We've been doing well so far. Okay, then the next one is the sinking fund. Now, sinking fund means, let me give you a practical example of when somebody says a sinking fund. You want to send your child to the US to study in 5 years' time. And the cost, the school fees is $75,000. You now ask yourself, how much can I be sinking? Or how much will I be saving? Such that in 5 years' time, I will have $75,000. So the money you are supposed to be paying in every year or every month is what we call A. Remember what we say A is the annual what? Then the future F is that future amount that you are expecting. Okay, so let me quickly digress and just solve this example so that all of us will come to speed with what I'm saying. So what's the question again? I want to send my son to the US to study biomedical engineering, and the school fees is $75,000. You know, the thing doesn't increase. This is not Nigeria. So my question is, how much can I be saving every year for the next 5 years? Any idea? Now, what do you do? Let me just solve it. So what you do is this. So the future amount I'm looking at is $75,000. The sinking fund or the savings I want to be making is what I don't know. The number of years is 5 years. Now, UBA is telling me that they can give me 10% every year per annum. That's what UBA said. So they'll be adding any money I put in the bank, they will add 10%. I mean, we all know how it works. So the interest rate is what? 10%. So P does not come. So remember those 5 parameters I gave us. So in this case, and I didn't say this, out of those 5 parameters, 2 are constants, N and I. Then 1 among the 3 will be given. So in this case, we are giving F. We are looking for A. So there's nothing like initial investment. There's no initial investment, but I have amount of money I'm targeting. Okay. Okay. So how do we solve it? So how to solve this? Ideally, you have to write down this formula. This is the formula to use. The mathematical formula is this. So, but this is killing. It is killing. So what we'll do is we'll now use the interest table. This is the interest table. So I'll go to the table. I'll look for where the interest is 10%. I'll look for where the number of years is what? 5. And I'll get the factor. When I get a factor, I will simply come and multiply it with the future value, and my answer will pop up. So if I want to put this down in a mathematical way, I will say, I'm looking for A, annuity. Okay. So annuity will be F multiplied by A over F. This is just a representation, comma, at a particular interest rate at a particular number of years. So everything in brackets can be read from the interest table. So if I go to the interest table, what do I do when I get to interest table? Oh, my interest table has closed. Why? Please, can we open our interest table once again? So when I get to the interest table, I'll go to the where interest rate is 10%. So you scroll down until you get to where interest rate is 10%. Scroll down. Scroll down and go to page 20. Go to page 20. Interest rates of 10%. Now let me see who is following. Okay, I heard you, Jinanua. Okay, now let me try us now. Which of these columns are we going to look for? Can you go through what I just said in 1 minute? Of course, this first 2 is out of it. This first 2, because these are for single payment. I pay money. How much will I get in 5 years? But this one is a uniform thing because the interest rate is coming every year. So once it comes after the year, it's reinvested. Then it continues again. It is reinvested. So how much will I be putting in the bank so that after 5 years, I'm going to have some amount? That's what they call sinking fund. How much will I be sinking? Remember when we talk about sink in engineering? Sink means something that you cannot recover. In other words, I'm putting this money in the bank. So after 5 years, they will quickly transfer it to pay my school fees. I can't get it back because that's the agreement. So which of these columns should I go to? First of all, what 2 parameters are involved? That is what will guide you. The 2 parameters are involved is F and A. F and A, so you do elimination. F and A, so the only 2 F and A I have here is this and this. But in this case, here we are to find A, while here we have to find F. So the column is going to be the 3rd column. So I'm going to go to the 3rd column at 10%. Column number 3 at 10% because I'm looking for money to sink. I'm looking for that amount, that annual worth. So that every year I'll just go to the bank and pay that money. Every year I'll just go to the bank and pay that money. Then at the end of 5 years, 75,000 will pop up. So what I'll do is this is it. So if you come down here at 5 years, the ratio or the factor is 0.1638. 0.1638. Are we there? I guess yes. So I will now come here. I'll now multiply this A will now become F times 0.1638. In other words, A will now be 75,000 multiplied by 0.1638. Okay, somebody that has a calculator, let us punch this. 0.1638 multiplied by 75,000. 12,000.
12,285.
So, gentlemen, if you want to get 75,000 in 5 years and the bank is giving you 5%, you have to invest 12,000. 285. But this is what the layman will do. This is what the layman will do. You will say 75,000 divided by 5. That's how much I'll be paying, but that's wrong. So that's why we talked about economic terms. And if you do that, I think to give you 15,000. Am I right? Yeah. So you can see the difference. You can see why the time value of money have interest rate. That interest rate they are paying you have drastically reduced this. Now, why do I demonstrate this? It can also mean vice versa. It can also be configured in this form. If I want to be paying in, I want to buy a car. Okay, I want to be paying in 20,000 every year. Sorry. I want to be investing 20,000 every year. Okay. And how much would that money be in 5 years? If in 5 years, if the interest rate is, let's say 10% again, let's use another 10%. Okay. 10%. Okay. So in this case, the formula will now be opposite of this. The formula will now mean F equal to A in brackets F over A. So that's the factor I'm going to look at I percent and at a particular N years. Okay. So my F is now going to be A, and that A is 20,000 multiplied by, I will now go to my interest table and look at the opposite of this. So in my interest table, the opposite of that becomes the one we didn't use before. So this is AF and this is FA. So in my interest table, this is now FA. I'm still on 10%. So I'm going to go under this table instead of going through this table. And this time around, watch me, follow me. At 5 years now, the first one I got 0.1638. This time around, I'm now getting 6.105. 6.105. So I will now come here. I will now put, sorry, hold on. 6.105. And that will mean something good. So that will mean 20,000 multiply 6.105. It will give me 122. So it means if I put 20,000 in the bank or in a good investment that is giving me 10%, after 5 years, I'll be richer by 122,000. So this is now the new amount of money at 5%. So you can see this and this are the same thing. It simply means this one I'm looking for the A. I was given the F. So that is what interest table does. Gentlemen, assuming you are asked to use mathematics or our normal Nigerian old school system, look at the formula you're going to cram. Tell me, are you ready to cram this formula? No. Now let me even bring it to you in the table so that you understand how the formulas are. So this is what the formulas are, and this is what the interest table is. So this is the, if you have to use mathematical expression, this is what you do. Okay. Now, the other thing I want to say is, let me quickly do this. It is not within the scope of this class, but I feel I should also do it so that some of us will understand the capability of Excel. Now, let me quickly solve these questions too in Excel. Watch me, stay with me. So this first question that we just solved, this. So let me copy it and then go to Excel. Though in the exam, you'll not be using Excel, you'll be using interest table, but it's as quicker. But in your real life, day-to-day work in your office as an angel auditor, you'll be using interest table. But if you can't use, you'll be using Excel, because Excel makes your work look very professional. So here, we are looking for A. So let me put the A here. So I'll go to Excel, go to the particular formula, to the particular, let me give it a color, the particular cell that I want to get the answer. So I'll go to formulas. You're seeing my screen. No. So this is my Excel. So I've copied those questions, the first question. So I'll go to, so this is the A I'm looking for, even though it's here. This is the future amount. This is the number of years. This is the interest. I'll go to Excel. When you go to Excel, you go to formula menu. This is formula menu. You click on formula menu. If you go to click on formula menu, it will bring out this ribbon, these ribbons. So under this ribbon, you will see financial. Please, you can open Excel and do with me. Just do one or two with me. This is not within the scope of this class, but I just want to show us. Then I will share a video at the end of the class where you can watch and learn how to use Excel. You might not have the time to do it, but I'll share the video with you. If you have the time to watch, the discipline to watch the video, you'll learn this. So I'll go to Excel. I'll go to financial. If I click on financial, Excel will open all the financial variables for me. Okay. I will scroll down. And go to A. You see A, annuity. Oh. Excel doesn't call it A. They call it payments, PMT. Please, it's called PMT. Don't forget this. Look at MPV, look at PV, look at IRR, look at FV. FV is the F. So the second one, we're going to use FV. But this case, if you're looking for A, you won't see A. Rather, the symbol, the name is payment. Meanwhile, remember what I told us, that A is also payment. So we're looking for what payment should I be making in the bank every year to achieve 5,000 in 5 years at 10%. So you now go to payment, you click on payment. If you click on payment, a dialog box like this will open. When a dialog box like this opens in Excel, if you don't know what to put in, just put your mouse inside any of those boxes. Excel will tell you, give you a hint of what to do. So if you put, for instance, rate, Excel will tell you rate is the interest rate per period for the loan. For example, use 6/4 for quarterly payments and 6% for annual. If somebody is giving you 6% payment and you want to calculate what the person will pay in a quarter, you divide the 6 by 4 because 6% is per annum. Therefore, the quarterly payment will now be over 4. The monthly payment will now be 6/12, and so on and so forth. So Excel will give you a hint. And that's a good thing about Excel. And meanwhile, that's why every engineer must know Excel. The rate is 5%, 10%. So I'll simply go here. Oh, there's something we need to do here. Sorry. I need to put the value here. You know what I mean? Yeah. This 5 will be here so that I'll do cell operation. So I'll click on the cell where I want the answer to come. I'll go back to my financials. I'll go back to PMT, which is payment, which is the symbol is synonymous to A. I will now come here and put 10% as rate. I'll just go and click the cell B5. Then number of I'll go to number of years. So number of years is number of PAM. Remember, number of years is number of payment terms. Okay. Let me finish. I'll take out that. I'll take out what we have on the screen. Then number of years is now 5. So I'll click on 5. Then PV, we are not given PV, so we don't have any business with it. Future value, we are giving the future value, the target value, the amount of money we are targeting for the future, which is this. Then I'll click enter. And the answer will pop up. So this is exactly what we got. 12,284. All right. Yes, of course. Yeah, look at it. Okay, 84. Yeah, some kind of approximation took place. This is more this was approximated manually, then and so on and so forth. So where am I now? So let me go back here. So let me solve the second one. Sorry. So the second one, is this. Yeah. So let me just solve it again. So in this case, we are now looking for F this time around. We're looking for F this time around. So I'll simply come here and still say post here. So put here 20,000. Here, I'm looking for it. Here is 5. Here is 10. I put the percent. If you didn't put percent, to assume it to be 1,000%. Yes. Then here, I'm looking for the future value. FV. Or F. I'll go back to financials. Instead of using the first one, I'll now go and look for FV. This is FV under financials. I'll click on FV. So the rates.
You're not seeing your screen.
Ooh.
Please, can you share the screen again?
Okay. Let me start over again. Okay. So this is it. So this is it. So you first go to the column where you want the answer to pop up. So let me just give it a different color. Good. So you go to this where you want the answer to pop up. Meanwhile, you have to increase this so that it doesn't. Then I'll go to formula menu. From formula menu, I go to financial tab. From financial tab, I go to FV because I'm looking for the future value. The future value of my 20,000 naira investment in 5 years at 10%. So I'll click on FV. The rate is 5%. The number of years is 5 years. The payment, you see payment now, PMT, which is now this, because you won't see A. Just know that A is PMT, payment, savings or payment, whichever way. When it's payment, it means it's a cash outflow. When it's a savings, it's a cash inflow. So this difference is plus or minus. And in Excel, once a value is minus, Excel will give it to you in brackets. So all you need to do is to go there and put minus in front of that thing. Okay. PMT, we don't have it. Oh, we have PMT as 20,000. Future value didn't come to the market. Then I'll click OK. Now, sometimes type simply means is the money coming, type in Excel. What you don't know, leave it blank. What you don't know, leave it blank. That's the rule in Excel. Because Excel assumes 0 as a null set. It's a null cell. So it's either you put 0 here or you put 1. If you put 0, it means the interest will pay at the end. If you put 1, it means the interest will pay at the beginning. So it means that's what we say end of year accounting. There's also beginning of the year accounting. Okay, so you just click OK. And the answer will pop up. Just increase the cell. So look at the answer. This is not the same thing we got. So let me leave it blank, plain. Now, why is it in negative? Because if it's in red color and in negative, it simply means the answer. For instance, this A is an outflow. Remember, I'm putting this money now in the bank. So it's an outflow, while FV is inflow, is the money I'm receiving. So what I'll simply do to change that negative sign is to come here and put minus to indicate the cash flow. And the money, the value is the same, but the sign will change. And the sign doesn't mean anything in engineering. If negative, it simply means against gravity. I mean, we know what I'm talking about. Okay. Okay. Any questions so far? Oh, I'm happy. Some people are even getting the answer. Okay, just wait. Assignment is coming very soon. So let me go back and share my screen. So any questions so far? Okay, so that is that. So I've listed the whole formulas, and the next is we're going to move into exercise. So before we move into the exercises, I would like to double down. We have time, we will need more time to do the exercises. I would like my second to come in and do a recap from a different perspective of what we have done in the last 1 hour, 30 minutes. Then we'll now go into exercises. We have a lot of exercises. Engineer Ishi. Hello.
Thank you, sir.
Okay, just let me give you permission to share your screen.
All right.
Before we do the exercises, I want you to take the participant and let it sink in very well, all through the costs and economic analysis we've done so far. So let me quickly make you a co-host. And so, gentlemen, let me introduce to us our second resource person for today. Engineer, she is also a GIZ trainer. Recently finished our training in Lagos to scale up this energy capacity building. So he has he's going to take us through a financial and economic analysis, which is similar to what I just told us now, gave us now, but he's going to come from a different perspective. After that, we're going to solve some couple of exercises because I want us to really grab the basics. Once you're able to grab the basics from a different perspective, then solving the questions that will come in or calculating your costs, which you're going to present to your clients, and showing that you have the requisite knowledge to perform those analyses will become something very simple and easy. Okay, thank you, Ishi. You can have the floor, please.
Okay, thank you so much, Engineer Uche. I want to thank everybody for this opportunity. So basically, Engineer Uche has given us an overview. So I'll probably just summarize what he has done. Financial and economic analysis is quite very important when it comes to energy audits and energy management. For example, in my organization where I work, over the years, we have suggested some energy efficiency measures over the years, more like technical stuff, telling them this is some of the benefits you can get, that benefit you can get from implementing this solution or implementing this kind of project. But to be honest, they didn't approve any of our stuff until recently, where we had to put some more money to each of these measures. So for example, this is the amount of money. You could save 10 million naira per year by implementing this, implementing that. And we're looking at some of these measures were implemented. So as energy auditors, it's very, very important for us to always understand some of these techniques so that it will help us in making decisions. So I'll just go through, because of our time, just some of the concepts he has said, and then expatiate on them more. So basically, like I said, management are more interested in money. How much will this cost? You know, what was the cost of it? What is the impact? What was the return on investment on a particular project on the bottom line? So finances is key, is essential. So basically, economic analysis helps us to compare the benefits. So most of the time, economic analysis is more like the impact on an economy. So for example, governments, you know, kind of subsidies by, can you see my screen, please?
Yes, something else is showing. Your screen was showing before. Now you've gone to
let me
another
share.
stuff.
Okay,
Yes.
can you see it now?
Yes.
All right.
This is your screen now.
Yes, yes. So I was saying economic analytics is more like a broader view. So more looking at the government. So what are the incentives that can be done so that to help reducing, for example, subsidy in terms of paying for electricity, while financial analysis is more focused on the benefits cost of implementing an energy efficiency measure to a firm. So basically, we use the same analysis, the same tools for both economic and financial analysis. We have talked about payback, so I wouldn't emphasize too much, but what I'll talk about more is that, of course, the shorter the payback period, the more attractive the projects. A payback period that is 2 years is better than a period that is 10 years. Like Engineer Uche said, he was advising that anything that exceeds 5 years should not be advisable. So, but every organization have their own maximum payback period that is acceptable to them based on their company policy or based on their own criteria. So, to be honest, simple payback period is very easy to calculate. And as energy editors, it's one of the measures that can easily be used to calculate and to see how the benefits. So a typical example is this one we have here. The cost of a new heat exchanger is this amount. The simple payback period in years, so we should calculate that, considering the annual savings of this and the annual maintenance cost of this. So like we said, the formula is capital cost over annual energy saving cost. So of course, the cost of it is 450,000. And then the annual savings is 60,000. But here is also that there's also a maintenance cost, which is added because you're maintaining the heat exchanger in this particular case. So you have to subtract this maintenance cost from the savings before you can get your payback period. So this is just a typical example of calculations of a simple payback period. And of course, the limitation is that most of the time, the money accrued after the period, as the payback period has finished, is not always calculated. So for example, this heat exchanger that was bought, of course, it's good to see be accruing more more savings after these 3 years, but this is not captured here. So typically we should have at least 50,000 naira every other year after the 3 years, so which is must also be like a profit to the organization. So it's also one of the limitations of payback. Another limitation is the time value of money. Engineer Uche emphasized that a lot. It's very important. Of course, money that is invested today accrues interest over time. And so simple payback period doesn't really capture this. Another tool is the return on investment. So it's usually quite straightforward. Some people say it's the inverse of payback period. So basically it's just the annual net cash flow over the capital costs. You hear people say, what is the return of investment of investing by 1 million naira in a particular project? So basically, or you just basically know how much is money I'm collecting every year, divided by the capital cost gives you a percentage. Payback period is in years, return on investment is really a percentage. And the percentage should be, of course, be higher than the normal interest rates that if you are borrowing money, or based on the criteria that's also acceptable in the company. So if your return on investment is 20%, you might say it's not a worthy project as compared to if it's a higher return on investment. Time value of money, like I said, $1 today is more valuable than what is received today. Engineer Uche gave us a graph where the value of 6,000 today in the next 5 years is about 10,000. So most of us will agree that what you could buy with 10 million naira or 1 million naira 5 years ago, you can't buy that same thing with 1 million naira today. So that's basically time value of money. And we've talked about present value, future value. We said present value is the actual amount at this current value at this particular time, and the future is the future value of an investment. But more importantly, it emphasized interest at discount rates. This is one of the most important parts of time value of money. So he has talked about the interest rates, they are all influenced by inflation and many other factors. But in simple terms, interest rates is basically calculating the future value of an amount from now, from the present value. So the rate applied to a present value to determine its future value. Why discount rates? Basically, you want to calculate the present value or to determine the present value of a future cash flow. So that's mostly the difference. But in every exercise, in every project, you're either using it's either you're using the interest rates or discount rate. It's used interchangeably depending on the scenario you're applying the formula to. So the basic formula is this future value is equals to present value, looking at the interest rate and the number of years. He talked about net present value, so I won't talk too much, but I will just give the acceptable limits. So if a net present value is positive, that is greater than 0, then it should be accepted. And then if it's, of course, negative, it should not be accepted, less than 0. And if it's just equal to 0, of course, it doesn't make any sense. So most of the time, it's quite useful to compare two energy management projects. So basically, you have two major projects you want to compare. So for example, you have a waste heat, and you want to use that either for your boilers, or you want to use it for your chillers, and you have calculated both of the project. This is the estimate of the cost, this is the savings, and then you compare both of them using net present value. So whatever you get gives you an idea of which one is a better one. If one is positive, one is negative, or the higher one that has a higher positive net present value, this of course is the one you probably want to go for. So a basic example is here. So a lightning retrofits. So if you, for example, lightning retrofit, okay, we want to also change incandescent light to LED. You can see basically the estimated energy cost saving per year is 40,000. The estimated life cost, typical LED can last up to 10 years. And of course, it was a discount factor of 10% here. Using this formula that is here, just basically this 200,000 is initial cost for the initial investments. Then 40,000 is the first yearly, divided by 1 plus the interest rate or the discount factor in this sense. Then calculate it for one particular year, second year, because the number of years keeps increasing till the 10th year. And we can see we have 45,780 here. So that shows it's a positive one. And so if you do this for another project and it's much higher than this, of course, you go for the higher one. So Engineer Uche taught us just now how to use both Excel. So things have been made much easier. So with Excel and interest tables, you don't have to start cramming everything here. Just get the basic things you need and plug it in. And internal rate of return, basically, you try to look for the discount rates where the NPV equal to 0. I will just dive into an example. So a typical example is here is a proposed project requires an initial investment of this amount. And the cash generated for the project is this. So this initial investment, and of course the cash flow for every year of the year. So like I said, IRR is basically to know when NPV is equal to 0. So, but you have to find the particular discount rate that applies to it. So in this particular case, what we did was to first try with an 8% using the same formula as NPV. And what we got is 2791. Of course, you see it's very high. The next one was that we try with a discount rate of 12%. NPV is 495, which is still not 0. And then another one, 13%. And the NPV is 6.65. So you could know that the NPV is probably going to lie between 12 and 13%, and more likely closer to 13%. And of course, there's an interpolation method we use, or you can even use Excel as well to calculate the actual IRR of this particular project. And so if you plug in that into this formula, you get the exact discount rates, so interest rates that this project is going to give you about 12.88%. So of course, this is, you probably want to know that whatever IRR you get, you should also compare with the cost of borrowing, the inflation rate, and many other things, and see if it's viable for you to go. So if, for example, the prevailing interest rate from the bank is 10%, and this thing is giving you 12.8%, of course, it's not a viable project that you want to do. Or you can basically, if you have the money, why not? And it's another investment entirely that you can go and drop your money in a particular bank that can give you 13 to 15%. So plugging your money into this particular project, and you feel that's more beneficial, then of course you can now. So basically, these tools are some of the things that really help us to know how the cash flow works, which project is viable, and which project will bring the highest return on investment. Cash flow analysis is quite important. Engineer Uche also mentioned that. So basically, initial investment, is usually downwards. Then all forms of inflows. So at the annual net inflows, of course, it's average value. It's average value here, of course, that's the end of life value. If it's positive, that where you can resell the equipment. So if you have installed, for example, and the end of value, you can sell average value. So everything that is pointing upwards is an inflow, and then investments, or for example, maintenance, what stuff that are pointing downwards. There's a graph here, it's not so clear, showing a typical scenario, an example of cash flows. So a typical one is like this, where, for example, you install a highly efficient energy motor, in the first few years, maybe because of the kind of load, maybe you're not using it optimally, maybe you're using it as half load. You can see that the cash flows might not be too much because you're using the particular motor based on the demand. But as the demand increases and the motor operates at a much higher level, the cash flows will definitely increase. So this will now help to know, gives you a general overview of the cash flow analysis of a particular project or a particular equipment. So, of course, we've talked about this. I wouldn't want to dive into this. Another important concept is levelized cost of energy. It's a measure to use to compare and assess alternative methods of energy production for engineers that work in about thermal power stations or the rest. So these are some of the concepts that are quite important to them. So it basically helps us to understand the average cost of building it and operating it divided by total energy generated over its assumed lifetime. So if you are installing a natural gas plant, for example, a thermal gas plant, you want to know how is the raw cost. You want to divide it by the actual amount being generated. So also you can compare this with using a solar direct alternative. What is the difference? So you'll be able to make your decision based on that. So of course, in calculating this, the estimated lifetime costs include the construction, the fueling, maintenance, training, insurance, and so on and so forth. And this can be divided by the system's lifetime expected power output. So if the price is lower than what you already have, so if you already, what you want to deploy, it's already lower, of course, the investment should be made. But if it's much, much higher with the existing, what you already have, then, there's not a viable project. For example, we visited Honeywell, one of the Honeywell plants in Lagos, and they recently just installed a natural gas plant, as part of an alternative to the lights they were getting from the grids. Of course, this was a cheaper alternative. Beside the fact that it was more reliable, they felt that the cost was much more effective when they compared both of them. So basically, this is the formula. I'm not going into it much. So total cost over the lifetime, divided by the electrical energy produced over the lifetime. And you can use your Excel to basically do those calculations to get it. We'll jump into financing. Financing project is very critical. We all know that funding, capital is it's very important. And so there's a popular concept of opportunity cost. So there's something else you want to use your money to do. So because of that, you might not have enough to deploy new projects or new energy measures and efficiency measures. So the other ways to get these finances is through either equity, debts, or other grants. And there are also others, leasing, vendor financing, and so on and so forth. Of course, debt is, as it assumes, it's just because it's a loan given with an interest rate collected over a particular time. The loans can be collected either from commercial banks, based on their interest rates and the time period, or both from multilateral development banks. You hear a lot of time where you have AFDB and others giving support with a lot of clamor on climate change. They're giving some cheap loans, for energy projects. And then we also have investment bank funds. One of such is Sunref. Sunref is one organization in Nigeria that's basically based on their criteria. They can give you a very, very cheap loan if you basically can prove that whatever energy efficiency project you are deploying meets the criteria they've given to you. So they give very up to 5 to 6%, interest rates, and it can spread over a long time. So that way you're not tying down your your money, your own personal money for those projects, you can go to these people, get this loan, deploy it, and basically the returns actually from the savings that has been made from it. It's not like you're paying from your bottom line, from your own returns, but more like the energy saving measures. What is the saving that is there? So the investments, the savings that is there is what you use to pay for the loans. And of course, there's the equity one, the straightforward. So someone can come and invest and say, okay, they want to be partners or in your business for investing this amount of money. So of course, the investor can basically acquire ownership based on the agreements that's made. And there are others, as grants. Like I said, you have a lot of organizations that are coming in to come and give almost like grants, almost like free, once they know it's viable. In terms of government ends, we know that REA is doing a lot of projects in terms of renewables, mini grids around the country. So basically, we get grants for that. Of course, there's leasing, more like leasing of equipment, leasing of if you want to replace your equipment, leasing for short term and for long term. And then there's vendor financing. Vendor financing just basically involves lending capital by a vendor, to do energy projects. Of course, it still involves higher rates, but it can also be a form of contractual agreement where basically I'll do this for you in turn, you do this, you do that for me. So you can have that handshake, so that can also come in. Factoring and forfeiting and other so different other measures that we can raise to make financing. Energy service contract is one of the new things that is now becoming very viable. So basically, it's an agreement between an industry and an energy service company. So basically, I would say it's more like outsourcing, where basically the facility or the industry can say, oh, you are in charge of all our energy. All we want is to just give us so amount of energy based on our requirements, based on our demand, and we'll pay you. So all the headache of installation of the power plants or generator, whatever you want to do is your headache. All you want is to make sure that you give us this amount of energy. Or it can be in form of energy efficiency, where basically, you see that there is this particular thing you can come and install or make us save some amount of energy. So you can come and install it, and then whatever savings is what you get. So basically, if you look at the diagram here, so the energy service company, you're here. So basically, they borrow money to construct projects. The SO repays lender from agency payments. Of course, the XO constructs the projects using financing. It improves using cost-saving measures, and then agency and related the agency, based on the budget and normal operations, it gets money from it, and basically it pays for cost saving. So this is a new model that's really becoming very popular. Some of my friends that are involved in renewables have come to meet me that, oh, we're ready to deploy some amount of solar panels in your office. You just come and we'll do everything, install it. You pay us a particular fixed amount spread over a long time, and we'll take care of the equipment and every other thing. So it's becoming a new model that is becoming rampant in Nigeria and generally globally. So they have different models. I will not go deep into them. There's shared savings, there's guaranteed savings, there's lease rentals, there's build, own, operate, transfer. In this particular case, the SO designs, he builds, finances, he owns the equipment for a period of time before he transfers it to the client. So he builds it. After a period of time, he has recouped what he has received from it. Then basically, he can now transfer it to the client. And then there's the build, own, and operate, more like a PPP arrangements. It's very particular. It's very common among government-owned facility, where private and public they form an EXO company where basically private investments is also there. So it's some of the energy service contracts models we have. All right, so thank you. This is just a brief of it because of our time. So Engineer Uche, we can go ahead now. Thank you. If you have any questions, please, very available to answer.
I hope you will share this on the platform with us.
Yes, please. I will. Of course, I will.
Yeah. Engineer Shi, thank you so much for that brief and direct to the point introduction to financial and economic analysis. At this point, I would like us to ask 1 or 2 questions. We'll be taking a small break of 10 minutes so we can stretch our legs, can drink water. Then the last 1 hour, we're going to use it to do some calculation, solve some of the questions that my colleague have raised. So any question, any contribution? Okay, while the break is going on, let me share the Engineer Shi, did you make any adjustment to what you sent me?
No, yes, I will send you the updated one now. Yes.
Okay, send me the updated one. You can convert it to PDF.
Yes,
and
I'll do that.
also share to the platform, or you send to WhatsApp. Yes.
No problem. Yeah.
So question time. Question time. If there's no question, we're going to converge again in 5 minutes. But you can stay around, and I'm not going anywhere. I just want to know that we have to take a break. This is 3 hours class. So we'll meet again by exactly 12. 12 on the dot. I will resume with the mathematical calculation. Then we'll do it for 1 hour and the class will close. Would that be okay?
Hello, thank you, coordinator.
Thank you, sir.
Can you hear me, sir?
We can hear you very loud and clear.
Now, we are all talking about financial costs. So let's talk about my own financial costs.
Okay.
During this period of break, that's about 10 minutes. Should I still hang on into the network because I'm paying the bill, or I should shut down and come in later?
There's losses. There's losses in any energy investment, sir.
Yeah.
So this 10 minutes, this calculates. We have 180 hours, 180 minutes. So 10 over 180. Let me see what it gives us.
Hello, sir.
Yes, I hear you, sir.
I think I'm on the same opinion with my Oga. The last
5%. 5% is tolerance. It falls within the tolerance limit of any engineering program.
Well, will you pay my bill? Will you pay my bill?
We'll resign this contract. We'll say plus or minus 5% loss. Plus or minus 5% losses.
Thank you,
I have
sir.
a question for Engineer Ashi. My name is Engineer Soji. Thanks for that presentation. In the presentation, I noticed that you focus more on this cost analysis and all that. Now, my question is, why you generate power or sources of renewable energies, how does this huge cost gets transferred to the end users such that they will be able to afford it? Because I can give you a typical example. If you go to the Apapa port where Dangote Sugar Refinery is generating power via the steam turbine engines.
That's the buying.
I did an assessment of that plant in 2014. Just a recovery
Heat
cost.
recovery. Okay.
Yes. For the, some in 2010, it was gutted down by fire. A part of it was gutted down by fire, and I was part of the team from South Africa that came to do the assessment. Now, Dangote is not using the grid; he's generating, and as such, is able to supply power to part of the port, and they are paying. And the cost is huge because he's got a license to supply power also.
Okay.
Now, if you are looking at residential domestic load, if you generate this power, these are huge costs. I didn't see in your presentation, maybe you still have it somewhere, how this is being transferred to the end users and how they are able to afford it, because these things are huge. I can tell you, they are huge. For instance, let me give you a typical example. Julius Berger Prime Tech in Abuja here. Now, Iduyard is supplying Prime Tech, is supplying Abumet, is supplying AFP and their staff quarters behind AFP there. Now, they don't use the AEDC line because it's not so they are generating from their, generators from LV to 11 kV, and they transmit to various transformers. These are costs that are involved, such that because it's 24 hours, the generators are running 24 hours there. How are all these huge costs being managed with domestic load? Because a lot of estate wants reliable power. They don't want quality power. They want reliable now that they can bank on maybe for 20, 22 hours. It's okay. And these are huge costs. I didn't see anywhere in your presentation how these are managed, such that whoever generates can also recover their own investment.
Okay.
Thank you, sir. Okay, let me respond before Engineer Uche. Yes, thank you for the good question. It's a major challenge. But first, we know electricity is expensive. Of course, if we're coming down to residential, we know it's going to be a little expensive to do it. That's why most of the times you see these gas plants, they're probably these energy service companies or that install these gas plants, like the examples you gave. They are either in hubs where they have different manufacturing companies, that can actually pay for this premium value.
Yes.
So that's the problem. Even right now, in Abuja, the ADC, they have what they call zones. So for example, where I'm staying, I'm paying almost ×2 someone that is staying in where I was staying before in Kuje, as compared to Lifetime. So I was paying almost 20,000 whereas where I was before, I was paying less than 3,000 to 4,000. Not because of the number of hours is there, but also I believe ADC knows that they recoup more money from these zones, so they give them more power. So yeah, one of the things that REA too as an agency faces is how to see how they can channel their projects, renewable energy, to areas where it can instigate economic value, so that of course, as they're using the power, they can also pay for it in terms of economic value, not just using it just for ACs and for stuff. So yes, I think in Lagos, I heard one or two of my friends have told me there are estates basically that are coming up. They are putting their own small generating plants, but yes, the amount they actually pay is much higher. So I think at the end of the day, it's economic value, as we have said. If the opportunity is there, the clients can pay, the residents can pay. Of course, there are people that are ready to come and invest and recoup their money over time. So I don't know if I've answered your question, sir. Mr. Uche, Engineer Uche, please, you can go ahead if you want to add to it.
Hello,
go ahead,
sir.
sir. Ask question.
No, it's not even about the question. Just to add to
please,
what.
excuse me, please. I
Yes,
have
sir.
something to say.
So,
My
okay,
hand is
who
up.
you
Defend you.
first? Excel came first. I don't know who
Okay.
I say.
Okay,
Hello.
please.
Okay.
My what I want to say is not a
Make it
question
brief.
per se,
Okay,
but
brief.
in response to what doctor just said.
Mm-hmm.
Well, I live. My family, we live in an estate in Warri. That estate, we are not connected to Benin electricity. We have our independent power plants inside within the estate, and it's a gas-driven engine.
Wow.
It's powered by CNG, so they bring CNG to the estate every now and then.
Okay.
So the tariff is quite high. It's really very high.
What was it like? Apart
from the normal tariff, we paid we pay 62 naira per kilowatt hour.
Okay, good. Why others are paying 50?
Yes, apart from that 62 kilowatt per kilowatt hour, we also pay distribution charge.
Okay.
We pay distribution charge, we pay admin charge and the rest. It is really very high. But when you look at it,
Your
when
liability,
you compare it to the cost of running your gen,
which is times 2
compared
times
to the
3.
cost of running your gen, it is, in fact, it is still far cheaper than the cost of running gen. So what I did in my own house, prior to that time, I already had a solar generator in my house. So when they brought this thing, I now look at it. So I increased the size of my solar installation. You understand? Thereby, most of the time during the day, my house runs on solar.
Solar.
Yes.
Let's simply say you implemented energy efficiency measure.
Yes, in the energy efficiency, and I know I have
not just conservation, but
yes,
but you implemented energy efficiency.
Yeah. So and I from my calculation, I know what I save on daily basis.
Good, of course.
And I already know the payback time for that energy saving measure, which I did.
It's good.
So
it's always
energy
good.
Is not cheap.
Less than
energy
2 years.
Is not cheap anywhere. Energy is not cheap anywhere.
Okay, sir.
It's not whether for residential or industrial, it's not cheap anywhere. Thank you very much.
Thank you, sir. The other engineer, please. We have like 1 minute so we can continue the class.
Okay, sir. I think the whole perspective is about the source of generation. We have to consider that.
Yes.
So if the source of generation, hydro and gas, they are quite different. Definitely one must be higher. So we have to observe that the source of generation in independent generation is in the like of those estate, definitely to be higher. But what we are talking about here now, I think it have to do with mostly mini grid that they now offer in rural areas.
Yeah.
So definitely the rural communities are even appreciating mini grid than even the normal conventional electricity now. Because I work, mostly my work have to do with rural area because I work with Niger State Electricity Board. And we normally go to rural area and we say, okay, we want to provide electricity. They normally tell us that they don't want conventional. They still call it NEPA. We don't have NEPA. We don't want NEPA. NEPA don't give light. But this one, 24 hours, no disturbance. They prefer mini grid now.
Thank you,
they are ready to pay.
Thank you. That's a good one. Before I take the next question, please, I would have loved to give everybody the opportunity to ask questions, but some of these questions, Omota, you have been asking questions on the platform. Please, can we just go to the chat room and give our perspective? Let me just say this, and we'll continue. As everyone have said, cost of energy is high. People are fed up with low quality, low cost. People want high quality, reliability. I think the renewable energy from solar is at 100 naira at the moment. It used to be at 150. It has come to 100. Conventional power is at 50. The independent power in Benin, in the estate in Benin, is at 62. But by the time you put the life cycle cost in, let's put it at 75. Engineer Excel, let's put it at 75 per kilowatts. So one thing I tell people is this: if not for the depreciation of the naira, the cost per kilowatt of renewable energy would have been around 60-50 naira by now. And you see the massive scale out of renewable energy in Nigeria. And that time is coming. And let's just wait for it. Because I know too well how Germany got to where they are. I was privileged to be in Germany then. It became a case study. It becomes something they study in school. To teach students, when they talk about energy and power, they use their case study to teach their students so that they will internalize it. And so what the government did, just like what the first person asked, government subsidized it ab initio. Government subsidized it to the tune of almost 50%. Then later on, they removed 25%. They removed another 10%. And today, they've removed their hand. And the industry is still growing. Because what people want to do is for you to, what government does is to energize the base. So once you energize the base, then when people key in, because another thing that helped them was the issue of having a smart grid. When I mean have smart grid, that the people were able to sell back to the grid. And when I came back recently, I tell people that, look, Nigeria is not yet ripe for renewable energy. But that is not the class for today. Next week, we're going to treat a very special, important topic on energy efficiency, and some of these things we are discussing here is going to come up. So I want to give our indulgence. Let us just give this class till next weekend. You're going to learn more. You have a more balanced perspective on these trending issues. I don't know if we are good to go. I don't know if you permit me to move on to our calculation.
Yeah, move on, please.
Okay, I'm going to move on now. Let me tell us again that what we're going to do now is covers everything you can encounter. Engineer Shi have talked about payback period. He has talked about levelized cost of energy, which you're going to meet again next week. So let me just do everything mathematical about this course. So everything you're doing today is the mathematical. This is the height of mathematics in this thing. So if you can grasp everything we have in this PowerPoint, then there's virtually nothing you can do when it comes to mathematical economic analysis of power projects. So I want to start from question number 2. You can do question number 1 later. So look at the question number 2.
A new lighting system. Okay.
A new lighting system. Well, this one, I can also do this one, by the way. Okay. Well, to confuse some of us, that's why I don't want to do it. Because this is like what I did before. Moving back through time, you'll find out that the 5 analysis, if the present amount is 100,000, the interest rate is 15%, and number of years is 5 years. The future value in 5 years will become 200,000 at 15%. Are you getting it? Okay. So from the table, you are supposed to read off this from the table. Then the present value remains what it is. This is 100,000 here, and that is what it is. Then to calculate the present value using formulas, this is the formula you apply. Oh, are you sure I'm sharing my screen? Yes. This is the formula you apply using mathematical formula. Okay. Then using the interest table, you still get the same 100,000. And this is the formula. Oh, you're still using mathematics. This is it. Using interest table, this is the factor. Then for the capital recovery, if you assume, sorry?
Can you start again, please?
So, okay, let me start again. So for this one now, we are talking about the present investment cost for the energy project is 100,000. You borrow the money at 15%, and your payback period is 5%. So how do you calculate these 5 economic indicators or 6 economic indicators? The red, what you see here is if you're using mathematical formula, this is what you apply. These are the formulas if you're using mathematics. Okay. Then if you're using interest table, this is the values you're going to read off from table. Okay. So for instance, at 15%, 5 years, if you're looking for the future amount of this 100,000 investments, you now go to your interest table here. You scroll down to 15%. 15%, you're looking for the future amount of a given present amount of 100,000. So the future amount after 5 years is what? 2.011. What is this? What is this teaching you? What is teaching you is that if you borrow money from a bank at 15%, if you did not pay back after 5 years, the money will double. Am I right? Yes. So this is the 2.1 you got here. Sorry. So this is it. This is 2.1. So if you multiply 2.14 by 100,000, remember our formula. Remember this formula. This is it. So you multiply everything inside the cell, which is 2.1, anything you got from the interest table, which is 2.11, by the given present value, which is 100,000. Okay, you are now going to get 201,000. I think it makes sense. It makes sense. It means if you borrow money from the bank at 15%, after 5 years, just know that the amount you borrowed have doubled, period. Then, if you are calculating for the future value, for the present value, of course, the present value will still give you 100,000. So this is the formula you apply. So if you do the reverse of this, you get back to this. So if you go back to your interest table cell now, for instance, this is the opposite of this. So instead of having 2.1 here, if you're now looking for the present value, this is what you get, 0.4972. Then, if you're looking for the annuity will be 29,826. So if you want to be paying money every year for the next 5 years to pay back 100,000, you have to be paying back 29,000 every year. If you ask a layman, if I'm to pay back 100,000 in 5 years, he will tell you it's 100 divided by 5, which will be 20,000. But if you apply the time value of money, it is to give you 29,000. And this one is more accurate. This one is more representative. And in Excel, this is the formula, PMT. These are the Excel annotation. That's why it says Excel function. This is the interest table values. And this is the mathematical expression. So you can see that these two values are the same, because whether you use this formula or use this formula, you still get the same thing. And then whether I use this formula, you can still get something. So given F, I can find the FV, I can find the A or PMT. I can find that amount of money that I have to pay back every year to achieve 100,000 in 5 years. I can also find the amount of money to pay back if I allow that money to stay and pay it back once after 5 years, which is now the future value. Are you with me? So that is that. So let's go to question number 2. A new lighting system will last 6 years and save 5,000 per year. The company purchasing it requires a hurdle rate of 15%. In order to meet the company's financial requirements, how much can they pay for the lighting system? I want us to digest this question. A company came and said, look, we can help you save 5,000 every year for 6 years, but we are borrowing money. The company says, any business I'm doing, I must make 15% profit. So the question now is, what is the maximum amount of money you can pay? So how do you solve this? So first of all, you list all the parameters as we have always done. So let me clear everything here. So the first thing I do is to list the parameters. So F, P, A. Oh, sorry. F, P, A, N, and I. So let's go. Do we have F? Please, can you make it interactive? Can you all hear me?
Yes, yes.
Okay, so quiet. Okay. It's okay. Yeah, mute yourself back. Okay, thank you. Mute yourself back, please. Yeah. Okay, so you have the question. Please open the question on your screen. Get the piece of paper.
Looking for present value.
Okay, we're looking no. Oh yeah, we're looking for present value. Yes, because we know how much we to save, but we don't know how much we should buy it. We don't know what is the safest amount to purchase it, because there's a 15% interest to pay on the money used in buying it, and it will only last for 6 years, and the only amount of money it's going to save us is 5,000. So from what I can see, future value does not arrive, so we'll eliminate it. The present value is what we're looking for. What is the annual amount? 5,000. For how many years? 6 years. The interest rate, 15%. So you will look for the formula that includes you look for the formula that includes P and A. Since you are looking for P, so the formula will now be P. We're going to multiply a factor by the A given. And what is that factor? It is a factor that gives us find P given A at a particular interest rate at a particular number of years. So can you go to your interest table at 15% under 6 years? Look for P given A. That is called, is it capital recovery or sinking fund? No, it's not capital recovery. It is present worth method, present worth. Can we do it?
Please, let's see the.
So this is the table. You have the Excel, sir. You have the presentation, sir. Open it on your system.
Present what?
Good. So we're looking for the present worth because we are about paying for this thing, gentlemen. We are about, ladies, we're about paying for this thing. So we want to know, is it worth it? We have known the amount to save. Instead of paying 10,000 AEDC, for those of us in Abuja, I'm paying 5,000. But how do I know how much do I pay and I won't run a loss? Or how much will I pay and it will be a worthwhile investment? Okay. So let me go back again. So can somebody help me with interest table, please? At 15%, 6 years. So this is my interest table.
3.74.
Sorry. Let's do one together. Then I move. Okay. So interest table, 15% after 6 years. Okay. Interest table, we are doing present worth. We want to know the present worth. So after 6 years, it will give me 3.784. 3.784 is the factor I'll use. 3.784, because I'm looking for the present worth of that investment. How much should I pay the contractor? Okay. So I'll go back to my stuff. And so P is now equal to 5,000 multiplied by 3.784. How much is that?
$18,920.
So it means that any price that is above 18,900, I should not buy it. That's what it means. So can you take time and digest this? And what is the implication of this? Please, one of us is playing around with his sharing screen and with his whiteboard. It is not necessary. Please stop it. Thank you. So any question on this? So look at it. This is it. So that's the question. So we'll move to the next question.
Sorry, can we transfer it to the Excel formula?
Okay. So for the Excel formula, I have something I've prepared on that. Let me open it. Just hold on. But can somebody start trying to Excel? Can you try? Can I see somebody try in Excel? So in Excel.
And we should just do it ourselves. Yeah. We can share screen.
Yes. Okay, so in Excel formula, the interest rate is 15%. Number of years is 6. Savings is 5. What is the present worth? So I put my cell where I want the answer to pop up. I'll go to formulas. I'll go to financials. You look for PV. PV. This is the PV. So the rate is 15%. Remember, the rate is 15% because it's annual. If rate is given in annual and you have to pay monthly, you divide the rate by 12. Just say divided by 12. Good. Just take note of that. Number of years is 6. The money it will save us, that is the payment. But inward payment, that is a receipt now, it's 5. Then you leave the other ones blank because 0 is end of year accounting. If you put your mouse here to tell you what it means. So it's giving us 18,922. Why is it negative? Because that's the money leaving your pocket. Remember in our cash flow, we say money leaving your pocket is negative, money coming is positive. So if Excel gives you red in bracket, it means negative. Any question? Question number 2. So this is how it is solved. Question number 2. A boiler economizer. What is a boiler economizer? Tomorrow, next week, you know what a boiler economizer is. It's something that you put in a boiler to save energy. It's an energy efficiency measure done in boiler. So it's more like something like a heat recovery system that will the heat leaving the boiler will heat up water, and the water coming into the boiler will be warm. So instead of cold water coming into a boiler, it is the warm water being heated by the exhaust gas or the exhaust heat that will heat it up a little bit. So with that being done, you save energy in the boiler. So that thing is called a boiler economizer. It is like I don't know. If you go just Google it, you see what it looks like. Just type boiler economizer, you see what it looks like. But that's what it does. Okay, the thing will cost 20,000, and it will last for 5 years. In other words, after like 5 years, it packs up. How much would the economizer have to save each year to return it? Just like as you said, and that's why we are teaching you this economic thing. Walk up to any client and tell him, change your LCD bulb, change your LC liquid display TV to LED, change your old refrigerator. He will not listen to you until you perform economic analysis and said, if you buy new television for 200,000, it will be saving you for every 1 hour, it will be saving you 2 naira. So in a day, it's saving you 15 naira. In a month, it's saving you 1,500. In a year, it's saving you 15,000. In 5 years, you've recovered your money. This thing I did now, you can present it in a knowledgeable way. That's the payback period. So if you present it that way, and it makes sense. Some of the old TVs are 200 watts. The new LEDs today are 80 watts. So the energy you are saving, let me do it mathematically. So next week we'll hear about that. So LED. So the old TV is consuming 250 watts. 250 watts, and tariff is 15 naira per kilowatt hour. So how much is, and you want to change it to a new LED that consumes, let me say it's a 50 inches or 40 inches, let's say 100 watts. And this TV will last for, let's say, 5 years. Or let's not even talk about 5 years. So for every 1 hour you watch your TV, you are saving 50 minus 100, which is what? 150 watts. 150 watts for every 1 hour. And so for how many hours do you watch television in a day? Let's say 8 hours. So for the 8 hours you're watching TV, you are saving 8 times 150 watts. And that will give you what? 8 times 150 is what?
1,200.
Sorry?
1,200.
So it's 1,200, which is same thing as 1.2 kilowatts. Remember? Because this is kilowatt hour. So it means every 1 hour, you are saving 1.2. Wow. Is this realistic? Yeah, of course it is. Every 1 hour you change that. If you change the new TV, for every 1 hour you watch TV, you are saving 50 times 1.2. We are saving 16 naira every day, actually, because we say 8 hours a day. So every day you are saving 16 naira. But somebody will say, what is 16 naira? Then do 60. Let's say you watch TV every day, times 30. It becomes more interesting. You are saving 1,800 every month. Now, 1,800 you are saving every month. Now, in a year. $21,600 per year. And last time I checked, that TV, the one for Hisense, that is the P, or the present investment, or the investment, whatever you call it, is what? 250,000. Let me not confuse with the other 250. So let me call it 300,000. Let me be. It's not up to that. It's about 250,000. Yeah, 250K. So payback period will now be 250 divided by 21,600. But then I'm wrong, because this is a simple payback. It's not a discounted payback. By the time you do the discounted, okay, with simple payback, you can have an idea of what discounted will be. Okay, 250 divided 21,600. I'm getting 11 years, but in reality, this 11 years, if you discount it, I can tell you'll be getting like 7 to 8 years. In fact, 7 years, believe me. If you discount it, but you know how to discount it, so you have to capture the interest rate and everything. So you can see, because this 21,000 you are this 250,000 is not moving, but 21,000 naira after 1 year might become 22,000. After 2 years, 25,000. After 3 years, 24,000. So if you now divide it, you'll be dividing 250 by, let's say, around 25,000, and that will be giving you around 10. So let me not go into that. But now you can see, if I am able to now, so some of you who are in this class, does it not make sense now to you? If I now tell you now to go and change your LCD, those are your old cathode ray TV, and not even to recover any money, dispose it, dash it to somebody, because I didn't put salvage value here, and buy a new one in the market that will cost you 250,000 naira. That in 7 years you will break even. It makes sense. Good. Okay, so let's go back to where we are before now. Any question on that? I think that is a very simple layman calculation of how these savings are gotten. You aggregate it for a day, aggregate it for a month, and finally find how much it will save you. So like the first one we did, we say it will save us 5,000. You'll be wondering, how did they get the 5,000? Well, maybe saving them 50 naira an hour, $5 per hour, $50 per $500 per month, blah, 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 whatever. But this is how much it will save in, yeah. So let's solve this now. Let's go. So this will be the last one I will solve with Excel and manual. Subsequent ones, we need to solve them. There are sample questions remaining that I would like us to solve. So now, what are we looking for, gentlemen? Who knows? Put in the chat box.
Present value. Capital recovery.
Yeah, put in the chat. I want opinions. I want 10 opinions. 10 opinions. What is given? What is present? What are you looking for? In fact, what are we asked to find? We're looking for what?
Initial rate of returns.
No. No, sir. We're looking for the A. We are doing capital recovery. That's the word. What do you mean by capital recovery? It means we want to find the A. Simple. So let's go back to whiteboard. Clear everything. Oh, sorry. Yeah, clear everything. So this question says, give me the parameters again. The capital, we're investing 20,000. Savings, we don't know. What's interest?
Okay.
How many?
12%.
12 years.
It will last for
5 years.
5 years.
5 years.
Oh.
So the formula from the formula, not the mathematical formula. I'm not interested in the mathematical formula. That one is old school. Is A into what? P. You go to your interest table. You look for what? A over P, because anything that is under is what you're looking for, and anything that is above is what you have. So A is above, means A is what we're looking for. So the A becomes what? Multiply by what? So let's go to interest table. Go to 12%. What did you see?
0.277.
Okay, let me confirm it, sir. Let others confirm it. 0.2774.
Yeah.
Okay. So So 0.2774. So what's the final value?
5,548.
548. It means that this thing must save 5,548 for it to be a good investment. So if you now perform your analysis, you must equate your savings, the proposal you are presenting to your client, you must equate it with this. So it means if he saves anything above this, you are good. If he saves 6,000, better. If he saves 7,000, even better. If he saves 10,000, oh, they should give you some money, and so on and so forth. So for an investment of 20,000 naira, to recover the capital, we need to be saving at least $5,548 every year for us to make sure that if 20,000 we invested at a borrowed money of 12% is equitable. Going back to Excel to do it. So I'll be sending this Excel shortly. Going back to Excel, you format your Excel this way. You place your copy here. You go to financial. All right.
Share your screen, please.
Share your screen.
Okay, I'm sharing it now. So you go back, you do it like this in Excel. So the interest rate is 12%, the number of years is 5%, the present value is minus 20. You know why I put minus 20? Because the investment is coming out of your pocket. The formula will be the answer will be the same. It's just like it won't come in red and it won't come in bracket, in fact, in brackets. So I'll come here. So I'm looking for how much to save. So I'll go to the formula menu, go to financial. I'll look for PMT. Then the rates, we all know. The number of years is 5. The present investment, the money that's going leaving my pocket, is this. Okay, so that is it. So can I give us 5 minutes to do it in Excel? If you've got it right, you say done. Open your Excel and do it. And also try to do it interesting. So I'm giving us 5 minutes.
Still give us right.
Sorry? Oh, hold on. Let me share. Let me share. Wait, hold on. Let me share this from this Excel, but I don't want it to. Yeah, let me share it. If you go to the Excel, please, you remove all the answers. Like this one, you remove the answer, okay? And try to do it. So let me remove the answers and send it to us. Just hold on. Let me remove the whole answers, okay? And I want you to try it. Or I think we're all engineers. We all have, if I say remove, you have to remove it. It's for your own good. So you. I don't expect anybody to cheat. So I'm saving it. So I go to the chat box now. Well, some people have even done it already. Wow. So the Excel has been uploaded on the chat box. Can you download it now? So solve question number 1 and 2 using Excel. You have 5 minutes to do that. Solve it with Excel. After solving it, you can also try with interest table. Interest table is like 30 seconds. And on the WhatsApp, let me also share it on the WhatsApp. Yeah. Just hold on. Okay, it's on the WhatsApp now. Who say you can't download it? It's not possible. It's not possible. Okay, she have also shared his presentation. I'm sending to the WhatsApp now. Others, we are solving a question. Don't listen to me. We are solving exercise 1 and 2 using Excel. In fact, you don't need to wait for the Excel. Create it. It's a simple thing. Just open any Excel and just put those values. Please don't need to wait for the Excel. It's very simple something. Today's presentation is going to be on the WhatsApp in the next 1 minute. Please, if you finish your answer, say done on the chat box. Once I see 10 people who have done it, we'll move on. Just put in done. Okay.
What's your problem? Please leave me alone. Have I ever been irresponsible where you went drink very stupidly?
They are not hearing you.
I think we lost him, sir. Let me see if we can get him back.
Okay, maybe that's why. Yeah, we'll see. The network, maybe the network is terrible. Yeah, welcome back.
Okay, so on the chat box now, we'll send those who are not yet in the group. So please, if you've done it in Excel, let me just let me get the feedback from you. Then let's solve one more question. Maybe we'll call it a day. Okay, Abbas, I've done it. Okay, question number 4. So question number 4. Question number 4, a company has asked you as an energy auditor to look at 2 projects. Each project will last 8 years. The first project costs 125,000 and will save 33,000. The second project will cost 153,000 and will save 46,000 each year. The company has a discount rate of 12%. Which project will you recommend? Which project will you recommend? Which project will you recommend? So we're going to solve this now. So what you do basically for this question is you treat these 2 projects as 2 independent projects, because they want to know which of the projects they will take. You can use the MPV method. You can use the present worth method. You can use the annual worth method. You can use any method. You can use different methods to solve it. But the best method to use in this kind of project is to use the annual worth. Why I was using annual worth? You use the annual worth method. We'll use the present worth method because they are both going to last the same number of years. If a project will last the same number of years, then you can have a common baseline. You can baseline them. Okay, but if they are lasting different number of years, you use the annual worth method. In other words, you ask yourself, how much am I making net per year? But in this case, we will be asking ourselves, what is the present worth? What is the present worth? What is the MPV? What is the present worth? So to solve this kind of question, okay, somebody says the second project is recommended. Why? That's okay. That is the idea of the training. You can't just say second one or first one. You have to put it out mathematically. And that is why you are attending this class today. You need to present it to your clients in a way that there won't be any doubting Thomases. You need to make it explicit and show it with sound mathematical and economic knowledge, including Excel, to prove beyond reasonable doubt to your clients that you know you're an expert. Okay, so let's go to our white screen, our whiteboard. So for the first project, please, somebody can help me. Is she? I don't know who can help me. What is the P? The F, the A, the I, the N. What's the P?
The first project, the P is 125,000.
Okay, 125,000. Do we have F? No. Eliminated. Do we have the A?
$33,000.
That's what?
33,000.
33,000.
That's the yearly savings that you get from it.
You know what the interest?
Yes, 12%.
12%.
Number of years?
8 years.
Okay. So project B or project 2. See, some people are already saying 1 and 2. So let me name them 1 and 2. Project 1. Project 2 is how much?
You have 153,000.
Savings?
Is 153 or not 143?
Okay. Savings?
46.
Okay. So now, then the question becomes, what are we looking for? So that brings us to what we are talking about when we come to net present value. This P you have here now is what we call the P of cost. We are now looking for P of savings. Just stay with me. Because your MPV formula is simply P savings minus P cost. And that's why engineer she said that when the MPV is negative, will you invest? No. When the MPV is positive, you will invest? Yes. When the MPV is 0, it means you're not making profit, you're not making gain. So this is where the thing comes from. So if you are using MPV method, then this P that's given is the P of the cost. In other words, this is the present value of the cost of the investment. But we don't know the present value of the savings. So, but the savings we are told is 33,000 naira every year, but we don't know the P.
For 8 years.
Thank you. So we don't know the P of this. If you are to aggregate it to present day, you don't know what it is. Somebody is giving you 32,000 every year for 8 years, for 12 years. How much are you worth now, today? Gentlemen, are you with me? And ladies, somebody's giving 33,000, it's going to save 33,000. So what's the worth now? That is why the P need to be found. So the P need to be found. Go through the question again. I want you to have a clear understanding of the basic principle so that there's no question you can't answer. And that is the idea of this class. So let's move with speed. We have 10 minutes to finish this class. Equal to, okay, A is given. Somebody prepare your interest table for me, please. Ahead. open interest table at 12% and under 8, and you are going to supply me the value. We have some younger people in this class, so they should be younger now. Okay. P is equal to, what's the savings? So what is what do you have in your interest table? Where
4.968.
Sorry?
4.968.
4.968. So can somebody also help me multiply that? We are moving. What's the final value?
$163,944.
163,944. So somebody giving you 33,000 every year for 8 years and giving you 163,000 today is the same thing. Now, this is the thing. If you ask a layman, he will tell you to give him 33,000 times 12 times 8. That's 264, but it's not true. 163,000 today is going to be worth 264 in 8 years. That's the meaning. So this is what we now have. So the present value is now this thing. So we'll now go back to this formula of MPV, because we want to know which one has a higher MPV of these two projects. The one with the higher MPV becomes the better project. So this is the formula. So MPV of this project will now be 163,944 minus 125,000. And what is that?
That is 38,944.
38,944. Is the MPV positive?
Yes, it's positive.
Is it a good investment?
Yes, it is.
Yeah. Yes, it is.
Yeah. That is to tell you that as an engineer, it is not every time you choose from bad, you are asked to choose from bad and good investment. No. Sometimes you have to choose from two good investments. And that what makes it even interesting. So this, you perform this analysis, you know, among the two investments, this is the best. Yes, two of them are profitable, but this one is a better one. And then by the time you speak the grammar as an auditor, your clients will be forced to invest. So let's look at the second project now, the MPV of the second project. So we'll do the same thing we did here. So here, we'll be looking for the P as well. So the formula, sorry. So the formula now is P equals to what? A. It's going to be the same ratio value. P divided by A, comma Y percent, comma N. And that will give you P equal to what? 46 multiply 4.968. And what's that value?
228,528.
Yeah, for the net. Minus. So those are said second is better. Maybe they have a point, maybe they've won. But you're not a magician.
25,000.
75,528.
So which one is better?
B.
Project 2.
Project 2. Project 2.
So if you present this for your clients, he will understand. You won't just look up, look down, and say project 2 is better. Things are not done. You can't be an engineer and be doing like that. You have to put it down in global standard practice.
Thank you, sir.
You have to put in global standard practice. And anybody who is not trying to bring out the money will bring out the money. The idea is for them to bring out the money and patronize you as an engineer auditor or rate you higher in your company if you're an internal auditor. they will now see you as being valuable, as bringing something on the table. Okay. Now, the last question, but I'm not going to solve it. So if you want to solve this, you go to Excel. Go to Excel, you go to question number 3. You see how I solved it. Okay? That is that. Question number 4, I'll show you how to solve it. Then by next week, I'm going to give us assignments, though there's no penalty. I wish there's a penalty for it. You're going to solve this. Question number 5, which one do you recommend? Now, what we just solved now, I can also solve it by using annual method. You see, this is savings. I can annuitize this cost. I can look for the A of this cost. And then know, this is this A of savings. Oh, wait. Good. This thing we solve, I can use 3 formulas to solve it. 3 formulas. I can use the MPV method. I can use the present what method. Oh, this MPV is the present what method. I can use the annuity method, and I can use the future method, future what method. So you can use 3 ways to solve it. If you want to solve it with the annual what method, what you do is you keep this savings aside, and you now find the A. This is a loan. This is the cost of the project. If I'm to pay back this money every year, how much will it cost me? If I'm to pay back that money every year, how much will it cost me? Are you with me? How much will it cost me? So somebody bought something for 125,000 for 8 years at interest of 12%. How much will I be paying back to pay back that loan? If I get that amount, I'll subtract it from 33,000, and that will give me my net annual what? The two projects, the one that has the better net annual what becomes the real project. Because this one says I'm saving 30,000 every year. But how much is it costing me? And the amount it's costing me is to annuitize this guy. So if I'm to do it, I'll simply say A equals bracket equals P bracket A over P, comma I. Why did I put I? 12%, comma 8 years. So go to interest table. Can somebody help me look at 80? Oh, we know it already. No, we don't know it. Can somebody go and look for me this formula?
0.2013.
0.2013. Oh, sorry. 125 times. So what's the answer now?
About 25,162.
So 25,162 is what it will cost me. This becomes the A cost. This is what is going out of my pocket every year if I spread this money for 8 years. But they also told me that I have a savings. And that savings is how much?
It was 33.
So the net money coming to my pockets?
About 8,000.
About 8,000. Now, I'll go and do for the second one, and we'll close the class. And I'll now give us assignment to solve. So for the second one, I bought it at 153. Okay. So same thing here. How much is it giving me?
30,799.
Check again, sir.
I multiplied that. It's still the same. Yes. 153 times that is about 30,000.
Okay.
150,000 divided by that is 30. So 30,000. 799.
But how much did you say it is saving me?
46,000.
Therefore,
about 16,000.
Thank you. That's a good one. Now, some of us who are lost, don't worry. You have the formula, you have the slide. We are engineers. So which project is the best? Is still the
Project
best.
D.
Now, if time will permit me, I will do it with the third formula. But the essence of the training is not to show you everything. Nobody will teach you anything in a training, but they will show you what you should know. So today I have shown you what you should know as an energy auditor. I've shown you how to calculate your savings, how to do your savings. Next week is going to be another bomb, because next week we're going to talk about energy efficiency. How do you save energy in boiler, in lighting? How do you calculate your levelized cost of energy? Because that's the most important, one of the most important parameters. How much is it costing me to produce 1 megawatt? Forget about the politics. Eh? Like yesterday I was watching CNN. They said the cost of producing 1 megawatt of energy from nuclear is $189. Yes, I saw it on CNN. Because France produces 70% of their energy through nuclear. While Germany is shutting down their nuclear. So Al Jazeera, not CNN, sorry. Al Jazeera said $189 for per megawatt, Oh, megawatts. Whatever. Huh?
There is 6 watts, yes.
Yeah, and they said nuclear, especially wind. Wind is the cheapest renewable energy. Solar and wind and nuclear thermal is costing 44, and it's expected to come down. Nuclear is not going down, except they'll come to Africa and kill more people in order to get more uranium.
I work in a nuclear agency.
Okay.
Sir, so I don't think you should just say that without hearing from our perspective. I work in Abuja too, nuclear agency, and I can always explain all these things.
Okay, you mean as per the
nuclear energy?
Okay.
Yes.
Okay. Maybe next week because we'll have a component of that. All right. You mean as per how they source uranium?
Conversation on the WhatsApp platform, so that next week we just concentrate on the cost.
I should do what?
We can discuss that on the WhatsApp platform. Why do we?
Okay. Okay, sir. Okay, sir. So this is what they say. This is what they say. This is what they say is the cost of megawatts. So I now did the calculation.
But it's on the map.
Assuming this is in Nigeria, for instance now. So 189 is 500 naira. Dollar is 500. Okay. So that will give us 189. Sorry, the class have ended. Let me pause. Let me stop recording.